What if I told you that the biggest reason home purchases fall apart isn't because of credit, isn't because of income, and it isn't the price of the house? Most people think that buying a home comes down to your credit score, but the truth is the deal usually lives or dies on documentation. And today I'm going to walk through a real story from one of my recent transactions that shows exactly how this works. Because this situation almost stopped a home purchase that took years to prepare for. If you're new to the channel, my name is John Abril. I'm a real estate and mortgage broker in the Inland Empire of Southern California, and on this channel I break down the real strategies behind buying homes, financing property, and building wealth through real estate. I help people find the house, structure the loan, and get the deal closed. So I see what actually happens behind the scenes in real estate transactions every day. And sometimes the biggest obstacles aren't the ones you think. Now, before I tell you the story, here are 3 quick things most buyers don't realize about getting a mortgage. Number 1, your credit score gets you in the door, but it doesn't close the loan. Number 2, underwriters don't approve loans based on assumptions. They approve loans based on documented proof. And number 3, if you're using an FHA loan, the underwriter's job is to make sure that the loan can be insured by FHA and sold on the secondary mortgage market. And that means the documentation has to match the guidelines. Exactly. Now, let me tell you about a recent transaction that illustrates this perfectly. Because this wasn't just another home purchase. This was a journey that took years. So the story begins a few years ago when I met a woman who wanted to buy a home. She had the motivation, she had the dream, but she didn't yet have the credit score required to qualify. And this is actually where most buyers stop. They look at the number, get discouraged, and then just walk away. But she didn't do that. Instead, she decided she was going to build her credit step by step until she qualified for an FHA loan. Now, if you're not familiar with FHA loans, they are one of the most powerful tools available for first-time home buyers because FHA loans allow buyers to purchase homes with lower credit scores and smaller down payments, but there's still a minimum threshold. And here's her situation. The goal was to reach a 580 credit score. That became the target. Now, over the next 3 years, she worked on it. She paid down debts, she monitored her credit, she stayed disciplined, and slowly, the credit score started climbing. Eventually, after years of preparation, she reached the magic number, 580. Now, technically speaking, that's just barely enough to qualify for an FHA loan with a 3.5% down payment. But that number represents something much bigger. It represents discipline and consistency over time. And once she hit that score, we were finally able to start looking at homes. Now, here is where the story gets interesting. Because credit wasn't the only factor in her situation. She had 2 sources of income. She had a W-2 salary job, which underwriters love because it's straightforward and it's easy to document. But she also had a small side business running a smog check company. Now, entrepreneurship is fantastic, it's great. But from an underwriter's perspective, business income introduces additional documentation requirements, tax returns, income verification, consistency of earnings. So right away, I knew we needed to structure the file carefully. Eventually, we found a property that made sense. The offer was accepted, escrow was opened, the loan was submitted to underwriting. And on the surface, everything looked great. Credit qualified, income verified, assets documented. The file moved through underwriting quickly. In fact, we were ahead of schedule. But then something happened that catches a lot of buyers off guard. The underwriter issued a condition related to IRS documentation. Now here's the key thing most buyers don't understand. The underwriter isn't trying to make your life difficult. The underwriter is acting as the gatekeeper for the loan. Their job is to make sure that the loan meets FHA requirement guidelines. Because if the loan does not meet FHA guidelines, it cannot be insured by FHA. And if it can't be insured by FHA, it cannot be sold on the secondary mortgage market the way FHA loans normally are. So the documentation absolutely matters, a lot. Now, in this particular case, the borrower had entered into an IRS payment plan from previous tax years, which actually is very common. People think owing taxes automatically disqualifies you from buying a house. And that is simply just not true. As long as you have a formal payment plan and you're making the payments, you can often still qualify. But here's where the issue came up. The documentation showed a payment plan, but it didn't clearly show all the tax years that were owed that were included in the same arrangement. An FHA guideline requires that all outstanding tax liabilities either be, one, paid in full or included in the documented payment agreement. Notice I said documented, so the underwriter paused the file. Now, imagine being the buyer in that moment. You have spent years improving your credit. You finally qualify. Your offer gets accepted. Escrow is moving forward, and suddenly, the loan pauses over a single document. This is where a lot of deals just fall apart. And it's not because the buyer isn't qualified, but because the documentation isn't clear. So we started digging. We logged into the IRS online portal, we pulled transcripts, we reviewed payment plan confirmations, and eventually we found the exact document underwriting needed, a confirmation showing that the payment plan covered the tax years in question. Once that document was uploaded, the condition was cleared, the loan moved forward, and the deal closed. Now, here's why I wanted to share this story with you. Because the biggest obstacles in real estate transactions are rarely the ones people expect. People think the deal will fall apart because of interest rates, credit scores, or home prices. But often the real issue is something more technical, documentation. So here are 3 practical takeaways you can use if you're planning to buy a home. Number 1, start preparing early. The buyer started working on her credit 3 years before she bought a house. That preparation made everything possible. If you owe taxes, don't panic. The key is having a formal payment arrangement and documented proof of it. And number 3, work with someone who understands both real estate and mortgage strategy. Because finding the right house is only half the process. Structuring the loan correctly is the other half. Home ownership isn't just about buying a house. It's about building stability, building equity, and building long-term wealth. And sometimes that journey to that moment takes years. But when it finally happens, it's so worth it. Now, if you found this helpful, please make sure to subscribe to the channel at The Realtor Broker. I post videos breaking down real estate strategies, mortgage tips, and real-world deals, just like this one. And if you want more information about buying or financing a home in Southern California, visit my website, johnabrill.com. Thank you for watching, and I'll see you in the next video. Don't forget to hit that subscribe button, like it, share it with someone that is thinking about maybe buying a house and has questions.